Welcome everyone to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do, thanks for checking me out again. As always, you can check me out on all social media platforms at EveryTimeICash. That's at EveryTimeICash. No underscore, no weird spellings. Spell it out exactly as it sounds. You can check me out on Twitter primarily, but that's all social media platforms at EveryTimeICash. If you want to keep things a little discreet, you could reach out to me directly on my website, everytimeicash.com/contact. This video, like all my videos and all my content, is for informational, educational, and mostly entertainment purposes only. So this is just a safe space for me to air my thoughts. It's not really meant to be used as financial advice. So if you're looking for financial advice, this is probably not for you. And I would say probably don't want to take financial advice from a random internet avatar, and seek the help of a financial professional. There's a lot of really good financial professionals out there. Reach out to one of them, go meet with a wealth manager, a financial advisor, and build a plan that'll work for you. Don't be that dude that YOLOs their child's formula money on weekly expiring Doge calls. Go out there and get some help. And if you're a gambler, there's a lot of really good numbers out there that you can call if you've got a little problem. So anyways, I like to make these videos at seminal moments or at critical junctures in the market. I feel like we are at one right now. And on the back of the ever anticipated Jackson Hole Fed meeting, and on the back of the end of the August quarter, I felt that it was appropriate to step in, make a video. I'd made two prior to this. I held them back because I wanted to see how we ended August. Figured I'd just make another one, and here we are. So, like all the other videos, there's going to be an audio version on my podcast channel. So if you'd rather just listen to it, check it out there. But I think this is going to be one of those videos you'd want to watch. It's got a lot of content in here that's visual in nature. So please, I would say check it out on my YouTube. Don't forget to like, comment, and subscribe below if you like the content, or even if you don't, leave me a comment. Let me know what you like, didn't like. But if you do like it, please click the follow button and turn on your alerts or whatever to get notified of the next one. Anyways, I'm rambling, so without further ado, I'm just going to jump right into it. On your screen, you're going to see the S&P 500. This is the S&P 500 from 2009 until today. And I wanted to start here because I think it's really important to kind of know where you are relative to historical means. And I've said this multiple times, whether it be in prior videos or on Twitter Spaces or on podcasts or whatever, that I like to use technical analysis as a map, basically. So the way that I'll liken it is, you use a map to figure out what route you're going to take to get to a certain point, or what route to avoid in order to get to a certain point. But before you even open the map, you already know, where you're going. Most people do, at least. So I like to use technical analysis in that. If I use that lens to kind of describe what technical analysis is, I like to use it that way. And in trying to figure out my positioning, or when to be aggressive, when to slow down, when not to be aggressive, I like to know where we are, relative to a larger period of time. And so on the screen, you're going to see the S&P 500 since 2009, when we basically bottomed out after the financial crisis. So essentially, you've got a 12-year chart on the screen. And with the exception of COVID, where I just threw an arrow up on the screen for you, with the exception of COVID, we basically lived in this upward channel. And, we would bang up against it and we'd roll over, bang up against it, roll over. And we've just been kind of grinding through the middle of this channel. We tested it in early January, late December of 18, early January of 19, and then we broke through last year on the back of COVID, but that was like an exogenous event. So essentially, we've lived in this channel for the entirety of the bull run, and we're pressing right up against the top of that range, right? So this is not to say that it's guaranteed to roll over. It's not to say that I'm going to go out and short everything. It's just to kind of give me and give you a little bit of a guide, kind of understand where things are and, when to kind of ease up. That's how, at least for me, when to kind of ease up and not be overly optimistic. So in this case, we're pressing right up against this resistance level, pressing right up against another resistance level that we've been pushing up against since April. So if I just draw this out for you, since April, we've essentially been pushing up against these levels. And if you want to get technical, you might have broken out of it, but you're not breaking out of this larger range that we've been in for a decade. So that's the first place I like to start. It's the first place I want to start. The second thing I want to mention is we haven't had a check back in quite some time now. So since COVID hit, really, we haven't had a real check back in the markets. We'll get these minor sell-offs. So we'll get these sell-offs down to the 50-day, 150-day. But we haven't had a check back. Since we've, when pre-COVID from 2017 on, we were in this like megaphone pattern that people were kind of using as a barometer for whether or not we're going to break down and the market was going to roll over. And since we've broken out above that, we've been just riding the 50-day. We'll get sell-offs back to the 50-day, and then it'll get bought, and vice versa, rinse, repeat. If I pull up the NASDAQ, it's not much different. If it'll load, that is. It's not much different. The NASDAQ has been in this upward channel ever since we broke out of a prior one. So we had a prior channel that we lived in. We finally broke through it. We retested it. We held. And since then, we've been just riding back and forth through it. And we're once again pressing right up against resistance, and the markets can't seem to find a way out of them. So these are not necessarily coincidental events. These are things that typically happen regularly. We've had rolling corrections. We haven't had a real one. So it's really important, I think, to kind of just gauge where you're at and understand where you're at before being sizable in any sort of trade that you put on, or being overly aggressive one way or the other. Now, outside of just looking at a chart, our tactical indicators under the surface are pretty much all extended as well. What do I mean by that? What I mean is there are a litany of technical indicators that technicians and people in general use, and a lot of them are flashing pretty bright red and saying that we are overbought and things do need to kind of come in a little bit. So for me, I want to start with the 14-week stochastic. It's something that a lot of technicians use. A lot of people who are trading the market based on charts primarily, and not necessarily on a fundamental scale, use this indicator among others. And this one is sitting at 96, which is historically high. That's all I need to tell you. The NAAIM exposure, which is essentially just a reading of whether or not people are bullish or bearish, is sitting in high optimism, quote unquote, territory. It's above 90. And then my favorite, I like to do a check of stocks that are sitting above their 10-day and their 50-day moving averages. 50-day moving average is typically like a swing moving average. 10-day is kind of more of a momentum indicator. And where I like to find washouts is when we're sitting on stocks above their 10-day being around 20% and stocks above their 50-day around 40%. So as you can see, we are on both of them at 70% basically. So 70% of all stocks in the S&P 500 are above their 10-day, and 70% of stocks in the S&P 500 are above their 50-day. That's a bullish thing. Like people are generally bullish, but this is a caution because generally you'll get these moments where the bulk of stocks will get aggressively bought and everyone's really optimistic and on one side of the boat. Something happens, boat tips over, capsize, whatever. Again, this is not me stepping in saying, hey, I want to short the market because I'm seeing something like this. It's just me saying I personally am easing up off the gas on the back of something like this. So another thing I wanted to bring to the attention is since May 31st, the S&P 500 is up about 7.5%. I think it's a little more now. I did this a couple days ago. It used to be called FANG, but Netflix is not that big of a company relative to the other ones, so we're going to call it FMAGA here. The FMAGA, which are Facebook, Microsoft, Apple, Google, Amazon, are responsible for 48%, a little bit more probably now, of the 7.5% that were up since May 31st. So essentially half the gains that we've had since May 31st have come on the back of these 5 big stocks. Now, the other important thing to note is Amazon has kind of underperformed the other ones. So essentially, we've probably gotten most of these gains from 4 stocks. You could throw in a 5th that's like another big one that I'm not thinking of at the moment. And then it's these big names are carrying the market. So that kind of goes in line with what we've seen since May. So you see these sharp, vicious corrections on the index side. So you'll see like the QQQ kind of check back, go to the NQ, go to the 50-day, get bought, and you'll see these rotations under the surface. So sometimes you'll see the market as a whole up, a 0.5%, but you look at your list and like a majority of them are down, and you're kind of confused on what's going on. And then some days you'll get the entire market up, and then like these 5 names or 6 names down, but the percent return for the market's not that high because it's being weighed down by these big names. And that's just a testament to how big these things are and like how they trade. So in general, these stocks kind of trade like treasuries, and that's a different conversation for another day. But basically, like they're trading as a safety and as a value trade, when in reality they're tech companies, right? So I wanted to bring this to the attention because as soon as these names pause, and I'm not saying they're going to roll over, but if and when these names pause, it could lead to an interesting dynamic where the market itself could stall out or sell off, and then you get pockets of strength within that, whether it be like defensive names like insurers, or whether it be a reopen reflation trade again on the back of like oil and cyclicals and things like that. So it's important to know where we are again. So if I go back here, the Nasdaq's telling you, hey, last time we hit these levels, we kind of rolled over. We haven't rolled over yet. And then, like I said, the S&P again, same thing. 10 years, we roll over we've rolled over every time. So it's one of these things where like I don't want to be caught flat-footed and on the wrong side. I just kind of want to know, and I kind of want to get perspective where we're at. Now, that being said, it's really, really important to not fight my man Jay Powell. So this guy owns the money printer. He's the guy who decides when the party's over. It's basically your dad. So it's important not to fight the Fed. So I saw a couple tweets this week that were pretty funny, basically in line with, imagine trying to call the top for the last 6 years and not being able to. So now justifying the fact that the market's rigged and that you hate the Fed. Some version of that, right? So like every other Uber driver or delivery boy has been telling you that they're bearish for 6+ years in the largest, despite the largest economic recovery package on record. They've been bearish and they've been wrong. And it's like just like the Fed has an infinite money supply, apparently they do too. So that being said, I want to emphasize that things that are overbought can continue to be overbought. So just because something's overbought, like if I go back to the stochastics, or if I go back to the SMAs, and I go back to all these different technical indicators, just because they're flashing red doesn't mean that it's time for me to just like take the opposite side. It's a time for me to be cautious, time for me to kind of pause and take inventory of where we're at, but it's not a time for me to flip to the other side. So I want to start there. Secondarily, markets can stay irrational longer than any of us can stay solvent. That's a famous old Wall Street adage. So it's important to know that, so that I'm, again, not on the wrong side of the boat, not getting caught flat-footed, and not trading my emotions. The most important thing is that there's a time to be aggressive and there's a time to be neutral. So again, if I just go back to the two charts, I go back here and then I go back to the NQ. There's a time for me to be aggressive, and generally speaking, those times are, most recently for NASDAQ was when we hit that 50-day and we bounced right off of it. That was the time to be aggressive to the long side. Other times are the trend bounces, so the 150-day trend bounce, etc. And then there's a time to lighten up. So right now would be a time to lighten up. We're pressing up against it and just kind of wait and see mode. Okay? And then outside of that, I want to say that seasonally speaking, we're going into the only period on record historically where we've had negative returns in the market. And that's September and October, September through early October. Historically, since people have been tracking this stuff, those are the 2 months that have underperformed all of the other months. So this is seasonally a shitty time. Kind of sucks because my birthday's during this time, but it's seasonally a shitty time. It's been a bad time for the markets. So who knows, right? There are always outliers, but it's important to know that. So you got bumping up against resistance, red lights flashing, telling you that things are overbought, and now you got seasonality all working against you. The other thing you have working against you is there's a lot of complacency in the market. So it's going to be interesting to see how things shake out. Historically speaking, there's an adage that says history doesn't repeat itself, but it often rhymes. So is history rhyming? So this is courtesy of Carter Braxton Worth from CNBC and Cornerstone Macro, I think. On his Twitter page, he mentioned that there had been 2 other times in history where we had 10 or more intraday all-time highs in the month of August. And those other 2 times were 1987 and 1929. So again, another random, in-your-face, skies falling potential and fear, right? So like, it's, again, the whole point of this exercise is to just know where you're at historically, and to just look at the caution signs as they're there, be cognizant of them, not necessarily take ludicrous action on the back of it, but just understand that they're there. So obviously 1987 we had the giant crash, and 1929 was the Great Depression. So these are nice little, Twitter tidbits and things to put up there. But essentially, these are not, fundamental reasons or technical reasons to go out and flip sides. It's just important to note, important to have that in the back of your mind should things kind of roll over, and understand where you are. So I know I've been pretty pessimistic, so I'm going to play the other side. I don't know who made this. Someone texted this to me, and I thought it was very worthwhile in sharing. And so if you know who made this, please at me, or mention it in the comment section so I can give them adequate credit. This is, again, not mine, so I want to make sure that I give credit where credit is due. But essentially, it's the same mantra of history repeating itself, or history rhyming, excuse me. And I just spent, 17 minutes telling you we're extended. We've been extended for a while. Overbought can become more overbought. We're at a situation that we've only seen 1987, 1929. And now I'm going to show you that in 1999 to 2000, we had a very similar setup headed into the October month, and that just of 1999, and that just shows you how powerful that breakout was and what ended up happening. So you could be pessimistic, and I was in high school in 1999, just barely. No, it was middle school in 1999, and so I don't have a recollection of what it was like outside of just like reading a history book or just an anecdotal experience. But what I do know from reading about this stuff is generally a lot of people called that time a bubble, and it from when it was like accepted that it was bubbling to when it popped was, depending on what you read or where you read it, somewhere between 12 and 18 months. So again, just because something is overbought, just because something doesn't make sense, just because something is telling you historically it was bad after this, doesn't mean that that's how it's going to play out. It's just a moment of inventory to kind of know what it is to expect potentially, but then also to keep in the back of your mind that stuff like this could happen. So we've gone up, and we're trading right now in situations that are like outside of normalcy and outside of reality. We've already debased, right? So people are assigning different metrics to why things are undervalued or why they should trade at lofty valuations, and people always do that, and they will always do that. But should we break out going into the end of the year, where a lot of portfolio managers and hedge fund managers are trailing the indexes and trailing their benchmarks, that could be a situation where a lot of people are forced to chase, and where people will feel the need to chase on the back of that. So not sure how things are going to play out. No one knows how things are going to play out exactly, but it is important to note that going into October of 1999, the Nasdaq essentially broke out and pretty much doubled over the course of the next 5 or 6 months. So it's really, really important to kind of take inventory of that and know where you are. So with that all said, right? So if I'm saying all this, and I'm not saying that I'm bearish, and I'm not saying that I'm bullish, what is it that I'm doing? And ultimately, what it is that I'm doing is I'm just being a little bit more tactical. So generally, if you follow like my Twitter and stock twits, I'm posting a lot of charts. I'm posting what it is that I'm seeing and what it is that I'm trading from time to time. And ultimately what I'm looking for, whether it was skills yesterday, or whether it is, SoFi today, or, the likes of Lemonade today, I'm basically looking for stocks that are in downtrends. Roku's another one, that were in downtrends and that are, whether they're holding a support level or whether they're breaking out of these downtrends that they're in. I'm looking for setups like that. And I'm looking for these kinds of setups in names that are not that big relative to the big names. So for me, I'm looking for like, 250 billion or less. I'm not saying that 250 billion is not a lot. I'm saying relative to Microsoft, Amazon, Google, etc., that it's not a lot. So I'm looking for names like that. And if you just take a look at Tesla, for example, Tesla technically broke out. It's at, the highest level it's been at since May or late April, but it doesn't seem like it's had much juice in this breakout. And, a big portion of that is the fact that Tesla's a large company. Another big portion, obviously, is that people are underwater. Tesla, if you were long Tesla outside of like being long late last year, if you were long Tesla between, let's say, Jan 1st and Feb 22, you're still underwater. And depending on when you got in and how you did it, a lot of these people are still underwater. This is not like a knock on Kathy or anything like that, but essentially this move that we had late last year was people front running the S&P 500 inclusion, and it was Kathy's inflows to start the year, where she had to buy the stock at pretty much any price, just to have it included in the in her ETF. So it's important to note all that stuff. it's important to kind of like put things in perspective. Um, I'm just going to try to go over just one or two more that I've kind of flagged on my side. So, you know, on the back of everything that I just said, where Nasdaq's pressing up against resistance, S&P is pressing up against resistance. Um, I want to kind of position myself or think of things of in terms of like what could happen going into the next couple of months should we start to see rollover. So for me, I'm looking at things like the cyclical. So I'm looking at things like Alcoa, which is, if I just extend this, it's a really sick uptrend that it's been in. I can get really wonky and really close here. So, but it's been in a really nice uptrend. Here we are pressed up against prior all-time highs or prior 52-week highs, and should things materialize and we get that rotation back into cyclicals on the back of growth stalling out, this is one of the names that could potentially do well. Outside of that, same exact kind of trade, same kind of sector, CLF, X, et cetera, et cetera. These are all the same type of trade. Should things find themselves in a position of rotating back to cyclicals. Outside of that, I'm looking for pretty much reasonable growth, pretty much value. So if I go on Pfizer and I go back, Pfizer is a name that I'd been long after earnings. It just basically broke out. For me, I'm looking to see whether or not this stock, if it'll load, whether or not we could hold this 50-day, right? So any breakout of this downtrend back above the 5 and 20, I want to be long. And then if we get back and retest that 50-day and hold it, I'd want to be long there as well. I'm also looking for, again, just really smaller names. I think this is where the most outperformance can happen going into year end. So again, assuming calamity doesn't happen and we're up to end the year and we're up significantly, a lot of people are going to be forced to chase some of these names, and the easier names that move towards year end historically, at least from a momentum perspective, are these smaller names that can get pushed around going into year end. So Open looks like it's getting constructive. For example, I mentioned SoFi. This is a name that I'm currently long using options. Nothing crazy, but if it gets above this 20-day, get an air pocket to that 50-day and that downtrend. Outside of that, things like Triple D, again, downtrend. If we break out, we go to the other one, break that, and go back up to that $40 level. And anything where I can get multiple layers of support or something to trade against is something that I'm eyeing. So these are some of the names. I'm just mentioning some of them again. D-Lo is one that I liked. Today it failed, didn't actually break out. But these are the type of names that I'm looking for and the type of names that I want to see unfold. So Purple is another one sitting on support from, call it, the last year, and so it gives you a nice level to trade from 24. Vizio was another one that I saw today, pressed up against prior support, which is now resistance at that $21 level. But essentially that 5 and 20 days should function as support. And so long as it does that, you basically get a trade with 20 as your downside, potentially up to that 50-day and 100-day convergence. So these are the types of names that I'm looking for. These are the types of setups that I'm looking for. JMIA was one, again, that I traded today. Broke out of this downtrend, and ultimately, once it got through 21, it had potential to get to 22. And the reason that I'm looking for these kinds of names is there's not only are they so beaten up, but because they've been beaten up for so long, their premium has eroded. So it gives you this asymmetric risk to the upside that trading a Google or an Amazon or whatever doesn't necessarily give you. So you're getting cheaper value on some of these beaten up names, or even on like the cyclical names. You get this value where you have a potential to see an asymmetric risk to the upside should things finish out. So again, just wanted to kind of give some thoughts around where it is that my head's at. I'm going to put out another video here in the next day or so, probably today. I'll make it today at least, of different setups that I'm looking at where I kind of hone in a little bit differently. And I want to just say thanks for watching. I hope you found this useful. If you did, please click the like button. Please subscribe. Please leave me comments and let me know whether or not you did like it or what you didn't like. Feel free to reach out to me again, as always, at everytimeicash or everytimeicash.com/contact. I'm on 2 weekly spaces with at Chad GSX and at Wolfe_financial. Check out the Wolfe Financial app. They have a pretty cool finance tool for people who are beginners, especially, and a really cool content distribution platform for finance. So check them out. Check Chad out. Give them a follow on Twitter. And again, as always, if you have questions, reach out to me at everytimeicash or everytimeicash.com/contact. So without further ado, excuse me, I'm struggling here at the end. Without further ado, please stay safe, stay profitable, and stay locked